for 99% of Americans, for you and I, filing taxes shouldn't be that complicated. It shouldn't be that convoluted. But unfortunately, or fortunately, depending what side you're on, our tax system, our progressive tax system, is designed with business owners in mind, small business owner to bigger corporation, and investors in mind. The government incentivizes people that save, incentivize people that put money into the economy. They help generate the growth of the economy. And they have booked this stick with all the different deductions and all the different credits that those individuals and corporations can legally use to help their businesses. But for you and I, it's not that complicated. Today, I'm going to go over not the full detail, but just the framework of how our federal income tax works. Just a high-level overview to keep this video fairly short and manageable, bite-sized nuggets. Our federal tax system should be able to fit on an index card or on one page of Google Sheet. And I'm about to illustrate that to you right now. So all you need is really the filing year. So what year you're filing, 2024. What filing status are you filing, whether you're single, married filing jointly, married filing separately, or head of household. And then your gross income. How much did you make? How much did you earn? That's your earned income, whether it's hourly employee or salary employee. That's your gross income. From gross income, your employer automatically deduct any traditional 401k. If you contribute to the traditional 401k, that gets deducted from your gross pay. If you have any HSA contribution, health savings account, that also get deducted from your gross pay. And all the premium, medical, vision, dental, and flexible spending account, FSA, that also get deducted from gross. So gross pay minus your pre-tax contribution and pre-tax deduction, that is now your wage on W-2, box number 1. And then your employer doesn't know all your other income, your side hustles, and all the different deductions. So the next section is other incomes and deductions. So that include any interest that you earn from the bank, any type of interest that you receive for the year, any short-term capital gains or loss, unqualified dividends, and also add in long-term capital gains or loss or qualified dividends. And if you have any traditional IRA, I should put traditional here. If you have any traditional IRA, which is individual retirement account, you want to also subtract that from the equation. And there is a phase out on how much you can make that you can actually deduct traditional IRA contribution. But for you, for my target audience, low to middle class, we don't make that much money to be phased out of the deduction from the traditional IRA contribution. And if you do make a lot of money, make sure you look up what the phase out is for able to deduct traditional IRA contribution. If you take the wage on your W-2 plus all the income and deduction, that gives you the adjusted gross income. The government used adjusted gross income, AGI, and also modified adjusted gross income to determine if you qualify for a certain credit, for a certain deduction, and different government program. So this is why it's important to calculate adjusted gross income and modified adjusted gross income. So the deduction above adjusted gross income is also known as above the line deduction, and a deduction below AGI is also called below the line deduction. So once you have your adjusted gross income, you take away either standard deduction or itemized deduction. Whichever is greater. And then you want to take away the long-term capital gain that you put up here, because we want to first calculate what is the ordinary income taxable amount. So the adjusted gross income minus the standard deduction or itemized deduction minus the long-term capital gain or qualified dividend, this derives you the ordinary income taxable amount. This is the amount where you get taxed by the federal government. Once you determine what your federal ordinary income taxable amount is, you go to the tax bracket for the tax year that you are filing for. So 2024 tax bracket is filed in 2025, but it's for tax year 2024. So depending on your filing status, these are the different rates for these taxable income. So for example, if you're a single, your first $0 up to $11,600 is taxed at 10%. $11,601 up to $47,150 is taxed at 12%. And from $47,151 to $100,525 is taxed at 22%. So by knowing what your taxable income is, you're able to calculate 10% of the first $11,600, and then you do 12% from here to here, then you add them up. That is your total taxable liability. If you have any long-term capital gain or qualified dividend, you want to look up what the capital gain tax is for 2024, which is filed in 2025. If you do tax year for 2025, it's filed in 2026. And these are your tax rate for the capital gain. Now keep in mind, capital gain is stacked on top of ordinary income. So these income range, these taxable income is stacking your ordinary income plus your long-term capital gain to determine what bracket you're under. But the actual taxable amount for capital gain is what gets taxed at these tax rate. And if you have a question on how it works, I have a video on how stacking ordinary income and capital gain works. Now if you add the federal tax income tax liability and you have any capital gain tax liability, that is your total federal tax liability. That's how much you're liable for the federal tax. And you have credit that's applied afterward. So child credit, earned income tax credit, or saver's credit, or any other credit that I'm not mentioning here. There are different types of credit. There are non-refundable credits and refundable credit or partial refund credit. And the difference between them is non-refundable credit will reduce your tax liability dollar for dollar, but you don't get any refund if you have excess credit. It stops at zero. But for the refundable credit, you get the full credit. So if you reduce it dollar for dollar and you still have left over, that's going to be refunded to you. But now that you have total tax liability, your ordinary income tax liability plus any capital gain tax liability, and then apply the credit to it, now you have your effective tax liability. Now the next thing is how much tax was held throughout the year, and based on that you derive to whether you owe or you get the refund back from the government. Say if your effective tax liability is $2,000 but you paid in only $1,000 but withheld only $1,000, now you owe the federal government $1,000. However, if your effective tax liability is $2,000, but you had $3,000 withheld, now you have a federal income tax refund of $1,000 because you overpaid by $1,000. This goes back to what I talked about in my other videos. Your tax refund or your tax owed is all dependent on how much you paid in, how much you withheld the previous year. If you overpay, you get them back. If you underpay, you pay the government back. That's all it is to it. Your marginal tax rate is basically the highest tax rate that you fall under based on your taxable income. But you don't pay the full highest tax rate because they are bracketed, they are progressive based on different income bracket. So your effective tax rate is basically the tax liability divided by your taxable income. In a nutshell, that one pager is applicable to most hourly production employee, material handler, even salary employee, junior manager, middle manager, senior manager, whose main income is wage earning income, W-2, and if they do have stock investment, that also is applicable as well. It is that simple to be able to file taxes. But yet, if you use TurboTax or H&R Block software, even when I answer all those questions, I still get confused to this day, because the application is designed to take into account for all the different filers. But for me, for my situation, for the 26 years I was working, this one sheet pretty much is applicable. Obviously, there's other stuff that I didn't include, like alimony, child support, those are all the income, or you have tuition, things like that. Those are the different deduction. But this is just to keep it simple, to keep it simplified. I will end this episode here so I can keep the boring tax subject more digestible. And in future episode, I will have more tax scenarios so you can see how this can be applied to multiple scenarios.